Greetings traders, welcome to my trading journal again. Today I would like to record my new trade to my trading journal. This is about a very simplest strategy, option strategy called Iron Condor that I have deployed. So idea here again is very simple. You just have to be little more risk averse. You don't have to put your Iron Condor legs close to where the spot is trading at. So let me just explain you what this trade is, right? So the entry of the trade is on Thursday, that was 13th of January, when Nifty was trading around 18,239. That's when I initiated an Iron Condor. I shorted a 750, 18,750 call, and I shorted 17,550 put, right? And to get a hedge of it, I went 150 points or 3 strikes away on the call side and just 2 strikes away from put side. So why I have done that, I will try and explain that, right? So here is the risk reward on this trade. You are basically collecting 10 points collectively, 6 points from call side. If you see 10 and 4, which is 6 point here and around 4 points here. So you are collectively, it's a credit strategy. You are collecting 10 points, and since the spread width on the call side is 150, your maximum loss on the call side is around 140 points, right? Width of the spread is 150, and the collection or the credit that you have is 10 points. So maximum loss that you can incur is 140 points here. And on the put side, since put side IVs are always higher, I try and put only 100 points width on the put side spread, right? So if you see, the maximum loss on put side is just 90 points, right? So this is how a very simplest strategy with which you can generate around 1% of return in a week's time. Let's say the margin required for this is around 2 lakh rupees, and you are going to generate around 2000 rupees every week on week, right? So collectively you are basically generating 4% of return every month, which again, if you extrapolate that to years earning, so you are basically generating 50% of return, close to 40 to 50% of return with this strategy, being very risk averse, staying very away from the spot and generating this rental income. So what if market moves violently? How we can adjust this trade? Because risk is huge here, because our spread width is 150 points on the call side, 100 points on the put side. How we can avoid big swings in the spot, right? So what we can do is, let's say if there is a 300 point candle tomorrow, what we can do is we can shift our hedge. So let's say in this case we are 18,750 short and 18,900 long. What we can do is we can book the profit or loss whatever we have it in the hedge, and we can move this hedge 18,900 closer to your short leg, which is 50 points, right? So what we can do this additionally, so this example, you are basically this particular call option is trading at 1.5 rupees, and you are getting another hedge which is 1.8 rupees. So with 30 paisa of giving up your credit, you are basically taking your risk off from what it was, like from 35,000 to you can risk up your call side to just 9,000, right? By just moving your hedge closer by 100 points and giving up just zero point 0.3 or 30 paisa, you are basically taking your risk off by almost 99 points. So that is how you can do adjustment on the put side as well. But then since your short legs or even the long legs are very long from the spot, I don't think that will be required, most of the time. If you see, the probability of profit is very high. 94 of the times you are going to win in this trade, right? So you just have to consider 6 times. By doing this adjustment, you can take down your losses to minimal level, so that you can continue to get this rental income on your strategy. So now I am going to book this trade. I am actually getting around 2000 rupees of profit, which is almost 1% of the capital deployed. I'm just exiting all position together. Perfect. So I've been able to exit from this strategy, and the next strategy that we have for next week is something like this, right? So we are again collecting 5 points. Let me just sorry, let's just collect 10 points both from call and put side. Again, if you see, call side 18,900, put side 17,650 is what we are getting. Again, the logic is very simple. You have to check, you have to go to the option chain. So for example, for next week, so what you are going to do is you have to identify a spread which has around 5 points in it, right? 14 and 7, right? 3 strikes away, you are getting almost 7 points here. And similarly, you have to go on the put side and you have to identify a spread which gives you 4 to 5 points. Here is what you can get 17,600 and 17,500. Again, I told you the reason why would you like to put just 100 points of spread width on the put side is because the IVs are higher, and the probability of having a black swan event on the put side is I would say 90% than the call side. So call side you can always adjust, even if there is a huge expansion, or even if there is a huge gap up, that is something that we can adjust. But then on put side, you really have to be taking care of your risk by just having a spread of 100 points width. So I'm not going to initiate this position right now. This is something that I've just opened it for looking at how much premium that we are getting. I will try and open this position on Thursday, because the volatility that we have in the Nifty is at peak on Wednesdays and Thursdays due to expiry. So I just don't want to, I just would like to see how it goes in next couple of days, and by 3 p.m. on Thursday is when we are going to initiate this position, by looking at the premiums that we get. And again, you have to see the delta of that particular premium has to be lesser than 0.10, right? So that is another thing that you have to consider when you initiate this position. So thank you very much for watching this video. I will update you on the next trade that I am going to take on this Iron Condor strategy. Thank you very much again.